Hi, welcome. I'm Matt Nimitz. It's an honor to chair this panel and to launch this conference. I've participated before, and I'm always impressed with the speakers, but also with the audience, the knowledgeable questions and comments. And I will use my trusty watch here to keep panelists within 10, 12 minutes. Make various signals and noises if they go too far over. As you know, the title of our panel is Macroeconomic Forecasts, and as a person who makes investments, I read all. You can't pick up the newspaper or any journal and not see someone making predictions about the future of China and the future of the world economy. And I'm hoping in this panel we can push the envelope to the point of getting the panelists to be as concrete as possible in their forecasts, even at the risk of giving us a range and their sense of confidence in where China is heading, recognizing, of course, that forecasts are just forecasts and no one's completely correct. I just take 2 minutes, just tell you for myself, I'm at a private investment group. We invest worldwide. We invest in China. We have office in Beijing for 15 years, in Hong Kong for 15 years, and opening in Shanghai. We've made investments over this 15-year period, about 20 investments, all on about $1.6 billion, $1.7 billion in investments. This year alone, we've invested $300 million in China. We have a lot of confidence. We see the ups and downs, but we also see just a tremendous economy, tremendous growth of the middle class, and all the crises of the financing system, of the environmental crisis, and demographic issues, and the securities issues up and down. And we recognize all those problems, but we also see a tremendously educated population growing and building a tremendous economy that's a major participant in the world economy. So we have in our group a sense of optimism, although we recognize that growth is going to be slower and there's going to be much more volatility in the future. But our planning over the next 10, 20 years is just continued investment in this economic engine. But now let me turn to the panel. The bios are in the book, and whenever I go to a conference, I always wonder why the chair repeats everything that's in here, and not only is the bios relatively complete, the nice photographs as well, so I won't make any introductions about the professional position of our speakers, but it is a very impressive panel. And so I'll start going down this. Paul Sheard, why don't you start off?
Great, thanks very much, Matt, and thanks very much for the invitation to this conference. I don't quite know how I found myself being the opening speaker here, but quite happy to take on that role. So my title, my presentation, I've got a background I'm now the global economist. I've been doing a global job for about 10 years or so. Can't really look at the global economy without looking at China. That looms very large. My background, have more of a Japan background. I lived there for 17 years. So I was going to talk a little bit about the sort of lessons from Japan. Japan, which sort of comparisons get made quite a bit these days. But just given that I'm sort of kicking off we're kicking off the conference here, I thought I'd just sort of frame things a little bit with some sort of, put some numbers around things. Given that we're talking about Chinese growth, I mean, the first point I guess to make about Chinese growth is, We used to talk about the Japanese economy in the old days as the miracle economy. Of course, China now has had, since Deng Xiaoping opened up the economy 35, 37 years, if you look at the average growth rate, it's about 9.8% over that period. By the way, I'm not going to get in these very brief introductory remarks into can you believe the numbers, a kind of discussion. That issue no doubt will come up during the course of the day, but let's just park that one for the moment. Taking all the official numbers as given, close to 10% growth in China for the last 35 years or so. If you know your sort of little arithmetic rule, that means that the size of the economy has been doubling at roughly about every 7 years, a little bit more than 7 years, and that's been going for 35, 37 years. So that's truly remarkable. But even if you look since the financial crisis, of course, that's been the big macro event of the last 10 years in the global economy, and you start the clock ticking from the fourth quarter of 2008, and you look at the average year-on-year growth in China, it's 8.3%, 8.3%. Some economies have barely net grown in that period, Japan and the Eurozone in particular. So that's truly a remarkable performance as well. That, of course, China, the other thing with China, which will come up, I'm sure, time and time again this morning, is the demography, a country of 1.3, 1.4 billion people. So it's a very large economy. And that rapid growth over three and a half decades and the population, of course, combined to give you what is now the largest or the second largest economy in the world, depending on how you measure it. If you just looked at nominal GDP, market exchange rates, then China's still the second largest. It's about 15% of global GDP. The US is about 24%. Japan's about 6%. But economists like to look at these things in so-called purchasing power parity terms. How far does a dollar go, if you like, in each country? And in those terms, China, as you probably know, has already surpassed the US as the biggest economy. I doubt if the average man or woman in the street in this country actually knows that fact. But a couple of years back, China surpassed the US. It's now about, on a PPP basis, about 17% of GDP, global GDP. US is about 15%. Japan's only about 4%. And China has also been the biggest, if you do a sort of a contributions to growth analysis, China has also been the biggest sort of arithmetic driver of global growth. When we talk about global growth being 3.5% to 4%, let's say China's accounting for at least a third, up to a half of that growth. But another key sort of fact is that if you look at it in per capita terms, this is where the very large population kicks in. China still has a rather modest per capita income. Again, if you looked in just market exchange rate nominal terms, it's only around $8,000 US dollars. The US is about $55,000, $56,000, so about a 7 times gap. Japan's about 33 on that measure. On a PPP basis, again, which is sort of probably the better way to look at things, China comes up to about 14,000. The US is still around 56 because that's kind of the benchmark here. So about a 2.5% gap between the two. Economists like to, when they look at growth rates, look at sort of growth accounting. It's a very static way of looking at GDP, but it's a useful sort of framework. Again, I'm sure as everybody in this audience knows, you can break down real GDP growth into sort of 3 components. It really has to, so if you're going to produce more output, it has to come from somewhere. You can produce more output by deploying more labor. You can produce more output by deploying more capital, accumulating more capital, and you can also produce, most importantly, more output by being more clever, the way that you use those inputs, that is technological innovation, or the fancy word being total factor productivity. So if you look at that breakdown in China, what does it look like? Chinese growth in 2014 was 7.3%. Of that 7.3%, about 5.6 percentage points came from investment or capital accumulation. That was the key driver of growth. Employment was very little. Again, the demographic argument, less than 0.5%. And total factor productivity, or sort of the innovation part, if you like, was about 1.3 percentage points. That also links to another key macro fact, which has implications for the growth outlook in China, is that it's a very, if you look at the composition of GDP, it's very investment intensive. The investment share of GDP. And of course, when you look at these numbers in China, private and public, and of course the kind of overlap between those two is quite blurry in some cases, are lumped together. But investment to GDP ratios around about 42, 43%. And the consumption to GDP, household consumption to GDP, is about 35%. So that's where, of course, you get the rebalancing argument. The key to growth in China in the future is to embark on this rebalancing process where the economy becomes, over time, gradually less investment intensive, less dependent on investment for growth, and more consumer and consumption, household consumption driven. That's a long process, obviously. Another key macro fact, just to get these macro facts out there to frame the discussion, is that China, like Japan, has for many years run a current account surplus. 10-year average, because it went up to about 10% prior to the financial crisis, is about 4.6%. Latest number is about 2.4%. So that current account surplus has come down, but China still runs a current account surplus. What that means, of course, to an economist means that China is a net lender to the rest of the world. So in other words, even though it uses a lot of its savings to finance its investment, it has a little bit of change left over. Which is a kind of a remarkable fact to essentially accumulate net claims on the rest of the world. So if you sort of put this all together, it's sort of a very large economy, but to a large extent that's because it's got such a large population. It's had very high growth on a sustained basis, but that growth continues to slow. Just to put a forecast out there, we would expect next year growth in China to be about 6.4%, the year after maybe about 6.1%. So clearly coming down to the low sixes and probably dipping below that before too long. But key fact, per capita GDP is still relatively modest. So I'm sure we'll talk during the day about the threat or risk of a middle income trap in China, but has a very high national savings rate, which helps to fuel this very high level of investment. Growth has been driven mainly by capital accumulation and, to a certain extent, catching up with the technological frontier. But what that all adds up to is, I guess, given the low per capita GDP in China still, there's enormous potential for China to continue to sort of catch up. I guess the convergence thesis is not so passé these days, but you know, if you think of China ultimately getting up to Japan, if not US, kind of per capita standards of living. And I don't see any particular a priori reason why that would not be possible. Doesn't mean it's going to be easy, but that means there's a lot of growth potential left in China. However, that growth, given the demographics, and given also that capital accumulation will also tend to be, to a certain extent, linked to demographics, and also, of course, if you want a consumption-orientated economy, you're going to have less savings to fuel the investment. So what that all adds up to is really, in terms of the challenge for China, growth in the future, if it wants to maintain consistently high GDP growth rates in order to become a high-income country on a per capita basis, which will make it a giant economy in the world economy, of course, because of that population, growth will have to be increasingly driven by technological innovation, by productivity growth. I think the key fact also I just put on the table here and remind ourselves is that China is still an economic development story, and it's also a transitional economy story, given the nature of the political system and the various institutions. I just note three things here. First of all, first one is that China has demonstrated this growth potential. So when we look to the future, there's a lot of China bears out there, and we worry a lot in our organization as well, and I'll come to why in a moment. But we shouldn't lose sight of the fact that China has, this is not abstract, this is not theoretical. There's a 35-year track record now of near double-digit growth. So that's something that we should put in the positive column. China is also, of course, in the right neighborhood of the world. For whatever reason, and we can debate that, most of the economic development in the last century, emerging markets, they've all tended to be in Asia, East Asia in particular, and China's following that pattern. And the third point I just make here is that, again, China is, though, unique. It's in uncharted territory. We've never seen, there's never been a case, maybe you go back to the arguments about 1800s, 1700s, medieval times, whatever, but in the modern era, to have the largest economy in the world and the biggest growth driver in the world actually being an economy that is still undergoing a process of economic development and trying to transition and change its political, economic, and social system. So no wonder it's an exciting story. Let me just close. Am I going for time here? Okay.
2 minutes.
2 minutes, okay. So let me actually say something about Japan. What are the sort of the lessons for Japan, or what does China look like, you know, when you look through a kind of a prism of Japan? And I have to say, not being a China expert per se, but spending a fair amount of time in China, you know, I always see a lot of parallels to Japan. Obviously, you know, both kind of Confucian systems, similar language script, but a similar, in many ways, approach to sort of thinking about the model of the economy and the role for the government, strategic planning and all that sort of stuff. But, you know, I think these comparisons can be rather fraught. Whenever you get into this comparison of two countries, there will be things which are similar, but there will always be unique features, some of which I've already mentioned. And I think really when you look at China through the lens of Japan, it's sort of more like a collage. There are aspects of what's going on in China which almost sort of you know, harken back to the Meiji era in Japan, to the early 20th century, when Japan was becoming a westernized country and bringing in and adopting Western institutions. There are elements of, obviously, parallels between the high growth period in Japan, 55 to 70, essentially, where growth was, again, in Japan, driven by rapid technological innovation, capital accumulation, high savings rates, etc. But there's also parallels or sort of here in the 1970s, where, of course, Bretton Woods broke down, the fixed exchange rate regime broke down, not just for Japan, but for most countries. But Japan started to open up its capital account and reform its exchange rate mechanism and its monetary architecture. Then you go into the 1970s as well. Japan experienced a period of loss of competitiveness with the oil shocks, the two oil shocks, and had to undergo quite a sustained and dramatic industrial adjustment process. And I've been very, for somebody who actually, part of my PhD thesis was looking at this process, being quite interested in what I've heard in China about the reduction of excess capacity in depressed industries, steel, coal, glass, etc. This is very much a Japan story of the late 1970s and 80s. And then, of course, 1980s, you have the financial liberalization, again, which China is going through. So I don't think there's, and then, of course, 1990s, bursting of the bubble and dealing with the credit overhang. So I don't think there's any one sort of period in Japanese history where you can say, aha, that's sort of what China's doing now. It's a sort of collage of different periods. But let me pick up on that last point about the Japan of the 1990s and the so-called lost decades and dealing with the aftermath of the banking crisis. And this is the key lesson that I want to sort of latch on to and leave on the table. If you look at China today, the key macroeconomic fact that strikes many people, including me, is this huge debt and credit and money overhang. Where did that come from? It came from the policy response of China to the global financial crisis and the Great Recession. Those stellar growth numbers of China, on average, since the financial crisis, growing at 8.3%, of course, was not just some just coincidence. It was actually driven by policy. Probably the biggest credit-fueled Keynesian stimulus in the history of the world in 2008, 9, 10. And that pumped up credit and debt and money supply in the economy. And if you look, I don't have the chart here, but if you can think of if you looked at bank lending, for example, or you looked at money supply, essentially two sides of the financial system's balance sheet, those variables steadily rose up until 2008. And then there's a kink in that series, and it kinks up and goes up at a much more rapid pace. And that has continued even though growth in China is slowing. And you can do different sort of crude metrics, but if you do just basically extrapolate the pre-crisis trend, say where would money supply, where would credit, where would debt be had it not been for that policy response to the financial crisis, that debt overhang number is enormous. You could do different numbers, but 60, 70, 80, 90% of GDP, depending on how you measure it. And this, I think, is the key. This debt overhang is kind of the key risk in China. Now,
why don't we leave to the discussion,
Right.
the question of whether we can solve the debt overhang. Okay. This will, I want to get the
Yeah, sure.